Imagine a market where the price you see on your screen is still flashing normally, while the real-world cost of getting the metal is screaming. That's the difference between paper and physical. And this week, one of the clearest stress gauges in silver didn't blink. It spiked. A former JP Morgan precious metals executive, Robert Gottlieb, put numbers on something most people only talk about in vague terms. London liquidity is tight enough that implied silver lease rates have pushed into the 7% range for key tenors, with London OTC forward lending rates deeply negative. Translation? In the real plumbing of the market, where bars move, financing happens, and delivery risk is priced, the system is paying a panic premium for access to physical silver, and when that happens, the headlines don't matter. The opinions don't matter. Only the mechanics matter. Because silver is not just a trade, it's an industrial input, it's a monetary metal, and it's a stress test for credibility. Today, we're going to break down what 7% stress actually means, why the London-New York connection is starting to behave like a broken hinge, how tariff risk becomes a weapon that freezes arbitrage, and why the timing is dangerous, because major commodity indexes are rebalancing right now, forcing huge mechanical flows into a market that's already tight. This isn't about hype, it's about signals. And when the signals look like this, you don't watch the chart, you watch the pipes. Let's get brutally clear on the language, because the entire story hides inside one misunderstood term: lease rates. A lease rate is, effectively, the cost to borrow physical metal, real silver, usually for a defined period, because someone needs it for inventory, delivery, financing, or industrial flow. In a calm market, lease rates are boring, low, background noise. They imply metal is available, lenders are comfortable, and the system is liquid. But when lease rates surge, the market is telling you something the screen price can't. Access is tightening. Gottlieb described implied silver lease rates above 7% for roughly the 3 or 6 month window, with around 6.75% for the 1 year horizon. That's not normal volatility, that's a funding shock. And here, S, where it gets even more revealing. London OTC forward. Lending rates can go negative. People hear negative and think it means someone is being paid to borrow silver. But in practice, it means the forward curve and funding conditions are distorted enough that the implied economics of borrowing and lending physical metal look upside down compared to what you indeed expect in a stable market. This is what stress looks like in the plumbing. It is not just that prices move, it is that the terms of access and the cost of certainty reprice violently. So when you see a 7% number attached to lease rates, don't file it next to interest rates. File it next to availability, because a market can be expensive and still functional, but a market that becomes expensive to access, especially at the short to medium horizons where deliveries and hedges are managed, is flashing a warning. The metal is there, but it's not free-flowing, and it's not being offered without a premium for risk. And once that happens, the paper market can keep printing its story for a while. But every day the physical market writes a different story in the background, one lease quote at a time. Now we move to the part that should make every serious trader sit up, the gap between markets that should not exist, unless something is preventing the usual closing of the loop. Gottlieb highlighted a very specific dilemma: March CME silver EFP pricing, showing a spread that looks like opportunity, until you price in the one risk that can erase the entire trade in a single headline: tariffs. Here's the simplified version of the trap. If one market is pricing silver meaningfully higher than another, normal arbitrage behavior is supposed to close that gap. Buy where it's cheaper, sell where it's more expensive, move metal, pocket the spread, repeat until convergence. That's how one global price is maintained in the real world. But Gottlieb's SI point is that the threat of a 10% tariff regime isn't just a political talking point. It becomes a market constraint. Because if you build an arbitrage position that requires shipping, timing, and settlement, and then tariffs hit, the spread can blow out against you so hard that what looked like yield becomes ruin. Now add timing, the part retail almost never understands. Big commodity indexes rebalance on schedule, not because a human has a new opinion, but because rules force changes in weights after large moves. And this week, major benchmarks, like those tied to the Bloomberg Commodity Index and the S&P GSCI, are in their annual rebalancing window, which can create large mechanical flows in gold, silver, and industrial metals. Mechanical means price insensitive. It means buying or selling happens because the index says so, not because the trade is smart. Reuters and other outlets have pointed to this rebalancing as a volatility catalyst right now. And the Financial Times has described the scale of potential flows as a major early test of 2026 after the huge 2025 run-up in precious metals. Here's why it matters. When a market is liquid and healthy, mechanical flows are absorbed, spreads widen briefly, then normalize. But when the market is already tight, when lease rates are elevated, when OTC forwards are distorted, when EFP and cross-market plumbing is stressed, mechanical flows don't just move price. They can expose weak points. Think of it like this. Indexes don't care if the street is icy. They drive anyway. And if the road has cracks, delivery constraints, financing tightness, tariff uncertainty, then normal flow becomes a stress event. Silver can drop hard on forced selling, then snap back violently if physical access remains tight and the paper move can create real supply. Or silver can gap higher if forced buying runs into a market where lenders are already charging a premium for access. Either way, the key is not predicting direction. It counts understanding that volatility in this window is not necessarily information. Spies. It can be mechanics colliding with a fragile structure. And fragile structures don't break where people are watching. They break where they're ignored, in settlement risk, in inventory location, in basis spreads, in financing, in the parts of the market most investors never see. So what does a 7% stress signal actually imply for the bigger picture? It implies the physical and paper layers are not moving in harmony. It implies the market is pricing scarcity of access, not necessarily absolute scarcity of atoms, but scarcity of deliverable, lendable, mobile metal under acceptable terms. And that's how repricing events begin, not with a single announcement, but with widening contradictions. Here are the signals that matter more than your favorite influencer's price target. 1. Implied lease rates and OTC forward bids. If they stay elevated or grow more negative, stress is persisting beneath the screen. 2. The EFP and the London New York basis. If the gap stays stubborn or widens, the loop is still jammed. 3. Policy risk, tariffs, restrictions, exemptions. Because in metals, policy is not just politics. It directly changes whether arbitrage is safe. 4. The behavior around index rebalancing. If silver shrugs off forced selling or rebounds faster than models expect, that tells you underlying demand and tightness are real. And finally, watch the language shift. When professionals stop describing this as volatility and start describing it as logistics and settlement, you're closer to the edge than most people realize. Now, a responsible line: this is not financial advice, but it is a reality check. In markets like silver, the biggest moves happen when the public is still arguing about the chart, while the insiders are arguing about delivery. And when a former bullion bank executive is openly discussing 7% implied lease rates, negative OTC forward levels, and tariff-driven blowout risk, you're being shown the battlefield map. Not after the war, but during the opening stages. The paper market can perform for longer than you think, but it cannot print metal. It cannot print liquidity. It cannot print trust. If the plumbing keeps tightening, the endgame doesn't look like a gentle trend line. It looks like discontinuity, spreads that don't close, volatility that won't compress, and a price discovery process that migrates toward whoever can actually source and deliver. That is why the phrase physical market broke isn't a meme. It's a description of what it feels like when access becomes the product. And if you're watching the right signals, you'll see it before the crowd does.